Welcome back to another update. So my Instagram DM is open. Do reach out to me if you cannot. Ask me something in the comment section below. I'll definitely respond within a week or two. So in this particular update, I won't be showing you sector charts or Nifty charts and those kind of things because the internet is flooded with all those and you know what is going on currently. But this is about outlook for 2025 and what are the key data points that you have to keep in mind. The first chart I'll open is that of common sense returning to the world. That is in terms of global leadership, global peace, and those kind of things. Now, I've read several research reports and I've just kind of handpicked the best slides that can sum up the entire situation for 2025. And wherever I have picked up slides from various reports or internet, the source is given here. For instance, this particular image has been sourced from the BCG analysis group, that is Boston Consultancy Group. So the ideal scenario for the global market would be somewhere here, where major powers actually start seeing the benefit of global cooperation, minimize military conflicts, and trade again goes on between countries without any sort of hurdle. This is the ideal scenario for the world markets. Currently, about 6 months back, we were here where it was regional conflicts that were dominating the headlines. Now we are somewhere between 2 and 3, and this is where we are kind of reaching a dangerous scenario. If you've learned anything from history, this is how World War started. And these days, World War can be a lot more different. It can be either cyber or bio warfare. Anything can happen. I don't know. But we are somewhere in the middle here. And this is where the new US regime that is coming in the US, it has to put an end to all of this because it won't take much time if things were to go out of control for us to move from point 3 to point 4, which is a global escalation and military kind of conflicts taking place all over the world. It's not unthinkable. Remember, I don't think any of us ever thought we would be witnessing something like COVID in our lifetime, but we did. That is why a possibility always exists. And for that also a chart I'll put up at a later stage. So in multipolar rivalry, what starts happening is that several blocs and countries start coming together and they form some kind of a front. You already are seeing this happening in terms of China, Russia, Iran. This is the one bloc that is getting formed. They're trying to get India on board. And the other bloc is the NATO countries, the US, Canada, Israel, that kind of bloc. And again, they are trying to get India on their particular bloc because India is at a strategic position. So if we will migrate to something like 3, that is 0.3 in 2025, that is going to be disaster for stock markets. And let's not talk about 0.4 because this particular thing no longer becomes about the market, but in general about humanity, which is never a great sign when global escalation happens. The next slide is about bilateral conflicts escalating to a global level. Again, a key risk in 2025. Post 2021, you've seen Russia, Ukraine, Russia, US. Then in between, there was Iran, US, Iran, Israel. Currently, there are a host of countries that are having bilateral conflicts, and you're seeing what is happening in the Middle East. Again, this remains a key data point for me because at times it seems as though the market has discounted everything that can go wrong in terms of geopolitical issues. But sometimes the problems that are just there in front of you blow up all of a sudden. And that, of course, remains the biggest risk for equity markets, in my opinion, in 2025. The next slide is about post-COVID. Every time we are seeing economic shocks across the system. First, it was COVID, then it was Russian invasion. Now the whole Middle East crisis that is playing out. Now, what is going to be the impact on commodities? What is going to be the impact on stock prices? This is something we are only going to see later in the year. Most of the headline markets, whether it is India, whether it is the European Union, whether it is the US, we are all coming back on hefty gains for the year 2023-2024. In India, many sectors have given north of 35 to 40% returns in 2024. So there is a lot of potential gain that can be wiped out if any of this scenario starts going out of control. Now, this is a historical chart that will help you understand why you can never rule out a major blowout of a regional conflict into something like a global conflict. So this chart you can see from the year 1900 and it's updated to, I think, start of 2024. Because if they had included the recent data, there would be more frequent spikes because of what has happened late part of 2024. So 1910, 1920 to 30 was a quiet period. Then you had the World War. Then we had multiple conflicts here. Market takes all these conflicts into its strides. Yes, in between you have periods of pain and market keeps moving ahead. This is post 9/11 what started happening in terms of regional conflicts. And now we are again entering a phase of conflicts. And you can see a lull in a cycle here, then a burst up, again a lull, then a burst up. So this is cyclical in nature. And now we've seen a cycle post 2005 5-6 to a period of 2020 where the globe was relatively quieter and you saw equity markets doing very well. The next 10 years, that is from 2021 to 2031, that is the risk. I know 2031 seems far away, but capital is limited. You get caught in one of these years where global markets start going haywire, your capital can take a serious knock. That is why keeping these things in mind is extremely important for the year 25 and also for the year 2026. Now, next I will cover that is the restoration of world order. And this will be very clear to all of us post January 2025 when President Trump takes over. See, there are two broad routes where the world can head into. Number one, global cooperation, where China, US, and the European Union come together and deliver global growth, which is going to be fantastic for the world. Or the fragmentation part of the global markets where China turns inwards, it is mostly focused on its own country. Taiwan comes into the picture. US takes a self-centered kind of path. That is what President Trump is speaking about currently. And European Union splinters into several smaller components, that is individual countries. And you're seeing the kind of economic problems that the European Union is going through, whether it is their automobile sector, whether it is their manufacturing sector. Everything is slowing down drastically. They're talking about huge layoffs. There's a lot of conflict happening between their employment union and that is the workers union and the industrialists. So this is never a healthy sign. It is imperative that for the year 25 and 26, US plays a key role in quietening down the world in terms of rhetoric. And it works with both China and European Union to deliver the growth that is required in this era. It will be clear. I think January is too soon, but I think by March, April, it will be clear what path US will be taking. And if President Trump delivers on what he has said in terms of tariffs, in terms of taxation, if he cuts tax, it's going to be fantastic for the stock market in the short term. That is something I'll come to. But whatever he has said about tariffs, whatever he has said about America first, and by America first, if those actions are going to hurt China and the European Union, then let me tell you, 2025 will turn out to be an incredibly difficult year for the market. Now I'll cover global market data and some key observations in terms of chart. Again, this is a breadth market data that will give you an insight about what is currently happening in the market. So the first chart I'll pull out is the breadth market for Russell 3000, which is the small mid micro cap segment of the US market. Now, what is happening post 2020, when the breadth was sustaining at higher levels, then you see some deterioration happening here. US market struggled between 2022 and 2023, and then again it started moving up. This time, if you look at the peak of 2021 to where we are today, and you plot a trend line, it will come down something like this. That is the mean value of a trend line. It tells you that over a period of time, the breadth in the market, that is the number of stocks that are taking the US market higher, is relatively lower from where we were a couple of years back. It was in the high 80% in October 2020, 2021. And this time around, as the US markets have hit a new high, look at where 1 year back the breadth was closer to higher 90%. And this time it topped somewhere at the 70%. And now, of course, the recent number is 28.6 because the kind of fall you've seen in the last couple of days. So breadth is actually deteriorating when it comes to the US market. And it is understandable because the rally cannot go on. You look at what US markets have done, I think again a 50% kind of a year in the last year. And the number of stocks that are taking that market higher keeps coming down with every cycle. It does not mean, despite that, you see, this is what I term as cycle. That is, the market moves up, then again market moves down, the breadth collapses. All right, I hope you get the point. So this recent market high came with a divergence in breadth. The next is S&P 500 data, similar kind of data. It was high 90% in October 2023, and this time around it was about 80% in July, August when S&P hit a new high. And recently when S&P hit a new high, it was high 67, 68%. Again, there is significant deterioration that is happening. You remove the top 5-7 companies from S&P 500 and the data becomes very different. The next slide is of Nifty 500. For Nifty 500, the contrast is even higher. In October 20, almost 90% stocks were heading higher. As the bull market has matured, the recent swing high was made at 80%. And now the retracement that you saw coming in the last couple of weeks, it happened with just 60% stocks having strong market breadth. Again, this is an indication that the markets globally are thinning out. Breadth will never tell you that there is a potential crash coming in the market. Crash as such is a strong word, And I think everybody fears crash. On the contrary, you should be happy if the markets go down a lot, because then you get the opportunity for the next 3-4 years. A lot of people could not buy post COVID because there was so much of fear on the street. And majority of participants, if you see the SIP data, they came in post October 2021 in a mature kind of a market. So expect that the markets will further thin out, and somewhere in 25, I think we will see a sharp dip where the breadth data resets, and again opportunity comes by for the next 2-3 years. Now the next data that I'll show you, this is time and price correction data. I've pulled it up since 2008. Can you see the spikes here? This spike came up as high as 210, which is about 50% of Nifty 500 stocks that are falling in that particular given quarter or that time period. Then you have a phase where volatility is not high, stocks don't correct, and the markets are wonderful to trade. 2011-12 was again a difficult year. Then 13, 14 we had a government change. Look at the calm here. That is where stock markets did very well. Look at the calm between 2016 and 18. Again, markets did very well here. Then came a cycle of a lot of spikes, a lot of frequent corrections. Then, of course, COVID hit a peak. Then there was a relative quite a period between 2020 and 22. This is where massive money was made. Again, such period came between 2022 November to recent June 2024. That is when the volatility and the corrective price action that you see has again started spiking up. But we are nowhere close to where we were in 2022 or 2018, 2019 or 2016 or 2013 level. This is important to understand. It is important to understand because a lot of newer players who have come into the market have not seen these spikes. And these spikes are price moving with momentum in a very short duration. That is what causes this spike. I don't exactly want to give out the formula for this chart for obvious reason, but this is a time and price kind of an indicator that I'm sure a lot of you have constructed with different kind of data points. I've made this with simple average true range. That is the hint I can give you. So in 2024, this was the June phase, the election phase, where we see some sort of spike coming in, and then the market again went into some lull phase and we saw price moving up again. But these spikes are becoming a lot frequent. And I think this period, something like this, a multi-month time correction is what market is heading into. And in between, you will have price pain also. So market will be in a range, but in between, we will have a lot of volatile movement. I'll come to that specific chart in the next segment where I cover the Nifty market data and what are the probable movement in terms of a range that can happen in 2025. I think will happen in 2025 is a broad range for the headline indices. Some sectors obviously will outperform. You will have to check that in terms of relative strength. But for a broader market index like a Nifty 50, Nifty 500, Nifty total market index, or a small cap, mid cap, I think this election pivot, this is going to be the floor for the market. And the markets will remain broadly in a 15 to 20% kind of a range for the next 12 to I think 18 months also, where individual pockets of sectors and stocks are going to do amazingly well. This means 2025 to mid of 2026, I think, will be a bottom-up market where stock picking is going to do wonders, but too much of attention on Nifty, Nifty 500, Bank Nifty is going to shake people out of their position. So this is what is going to happen. Within a broad range, you will see periods where market prices will come down. It will shake a lot of people out. And just when things will start getting a lot more bearish, another up leg will resume within this range. So what has to be done? In the recent times also, when we have seen market moving from 21,000 to 23,000, a swift move of 15% or 12%, we've seen this phase. Now, at the point where markets have started correcting again, the leaders that you picked up in this phase, the stocks that did very well in this phase, this is what you have to retain. And you have to cut everything out when you start sensing a correction coming in the market or a mini swing move coming into the market, because that can also turn out to be a bigger move. Now, a lot of you will tell this is visible only in hindsight. To that, I will say it's not true. If you track your portfolio closely, market data closely, a couple of days before these things begin, you will be able to understand. So it is possible, but remember, you won't be able to time that with any indicator that you have on the chart. Portfolio is your greatest indicator. Portfolio will tell you when it is moving up. It will tell you when it is stalling. It will tell you when you have to take corrective measures. So currently we are in this sort of phase. I don't know whether we are here or whether we are here, whether we are here. That is something I don't know. The screen does not look good. This is a weekly candle. It is engulfing last 3 weeks of price action. Probably this gap is now going to get filled on Monday, Tuesday, Wednesday. I don't know when. There will be a lot of shakeouts. But this is the range that is going to be there for 2025. You have to lose less when you're caught in this phase. You have to accumulate, be nimble in this phase. And then as the market again has a leg up, you have to be very careful in which names you have to retain, in which names you have to book profit, and in which names you have to completely exit. This is the market that is coming, folks. The easy part of bull market, which I made a video about, I think a couple of months back also, that phase is over. Now you have to be nimble footed, you have to be choosy, you have to go behind pockets that will do well. And relative strength during that phase is going to be your best friend. Now, traditional versus new age. This is the last slide, so just bear with me. I think 2025, first point I'll cover is about interest rates. I don't think interest rates are going to go down a lot. They're going to roughly remain the same. You might get a couple of cuts here and there, but I think we are heading for a lot of pain in terms of economic growth globally. It's not India specific. India, we are having a completely different set of issues. I don't expect anything great coming out of the budget because the mentality of the government currently is to get revenue from wherever they can. And they have not made our corporate sector accountable for the same. Corporate sector rate cuts were done back in 2018, 2019. Government should hold corporate sector accountable as to what they have invested in terms of creating more jobs, creating more industries, creating more opportunities. Where is the accountability? Just taxing individuals, just finding ways to squeeze out the 6-7% people who pay income tax is not the way out of this problem. India is facing a systematic problem where consumption is slowing down. And I had an interesting discussion with someone I discussed stock markets with, and he told me that there will be a stage where consumption patterns will fall to such an extent that consumers will fight back in terms of taking revenge from the government in terms of spending less. And you can see this happening in many sectors. I think the government, unfortunately, has killed our auto sector, where if you go out and buy a 30-35 lakh car, you're paying out 7-8 lakhs in terms of taxes. This is not the way out. And I think the government is shooting itself on the foot by taxing people unnecessarily, finding every avenue to squeeze the life out of taxpayers. So that is what is happening. I don't believe that the demand is going to come back so soon in 2025. This union budget, government will have to take steps to put money back into the hands of people without having a serious impact on inflation. If in budget you see nothing happening, then you're going to see a lower high, lower low market for the next 12 months in between the new age companies that I'll come to in a bit. Sectors, they are going to do well, but the traditional large cap players are going to struggle immensely. With respect to economic growth, I think it will be stagnant at best, and we'll be incredibly lucky if we can clock better numbers than the last 2 years. I don't think that's going to happen. Market conditions, period of wild swings are going to happen. And you have to be very careful to not get into the trap of short selling. Whenever you see markets correcting, remember that is an opportunity. Prepare for this swing. How do you prepare for this swing? I've done so many videos on this. Please go back to the channel. Everything is free. Make use of these things if you want to seriously learn in terms of how to do well in the market. Retaining winners of each cycle will be important. The next is new age economy. Every now and then you are seeing new age companies coming into the market. Currently, you have seen companies like Swiggy coming in. IKC was one more company that recently listed. Very interesting business model. There are a lot of companies coming into the stock market with such amazing business models, and virtually they don't have much competition. I think 2025, 2026 is going to be the year of new age companies, new age sectors. This is where growth will be. This is where your portfolio will outperform something like a struggling Nifty 500, Nifty total market, or even something like Nifty 50. So bottom up will work, but not from traditional sectors, from new age economy. Look for those companies specifically that are growing at a rapid rate, double-digit growth, operating profit margin double-digit, and where the debt is not too high. Because I'm not that bullish in terms of interest rates supporting the stock market, debt is going to be a big thing when it comes to overall construction of your portfolio. All right, so I'm not bearish on the stock market. Stock markets will just go through a routine time price correction. In between, you're going to get some amazing opportunities in stocks. Don't be myopic in terms of trying to catch the next 2-3%. When it comes to short selling, it completely messes up your psyche. Instead, whenever the market is falling, look at those stocks where relative strength is clearly trending higher, that is showing strength. Those are the stocks you need to focus upon when it comes to the next swing in the market, which is what 2025 will be. This is something you're going to see a lot more frequent in 25. This part, it's over. It's not coming back so soon. All right. So have a great weekend ahead. Wishing you guys a fantastic 2025. My Instagram DM is open. I'll see you guys probably in January 1st week 25. Take care and be safe.